Hey investors, welcome to my channel, where we turn complex financial reports into actionable insights. In this video, I will walk you through companies' key business metrics, analyze their growth trajectory, and break down their financial performance in simple, clear terms. So let's get started. Infosys is a technology company that provides consulting, technology, outsourcing, and next-generation digital services. The company operates in 56 countries, across 265 locations, demonstrating a substantial global footprint. The workforce employs approximately 317,000 individuals. In the past 3 months, there has been an increase of 2.47% in the stock value. Infosys operates through 6 key segments. These are Digital, Infosys Cobalt, Infosys Topaz, Application Management Services, Infrastructure Management Services, and Proprietary Application Development Services. The digital segment provides solutions that improve customer experience, generate insights from data, and implement artificial intelligence. It focuses on experience design, data analytics, and AI implementation. Infosys Cobalt facilitates cloud adoption for businesses. It offers services, solutions, and platforms to boost cloud transformation, including cloud advisory, data management on the cloud, and cloud security. Infosys Topaz focuses on accelerating business value using AI, especially with generative AI technologies. It includes generative AI solutions, AI-driven automation, and approaches to accelerate business value. Application Management Services offers support, maintenance, and enhancements for applications, ensuring they're reliable, secure, and aligned with business needs. Key services are application support, maintenance, and enhancements. Infrastructure Management Services manages IT infrastructure like servers, networks, and storage. It ensures reliability, security, and performance through server, network, and storage management. Finally, Proprietary Application Development Services develops custom applications using Infosys methodologies and tools. This segment involves custom application development, platform development, and tool development. Now, let's look at the shareholder returns of this company. Over the past year, the company delivered an impressive return of 15.13%, outperforming the industry average of 11.4% and the broader market at 8.83%. This highlights its strong performance and ability to generate exceptional value for investors. Let's examine the company's steady revenue growth. Revenue grew by 0.92%. Looking at the quarterly trend from Q3 2023 to Q3 2024, revenue increased from $4.7 billion to $4.9 billion, showing a fluctuating but overall positive trend. Revenue is simply the total money a company brings in before any expenses. Think of it as all the money in a store's cash register at the end of the day. The company maintains consistent production efficiency. Gross margin stands at 30.27%. Since Q3 2023, this number has fluctuated slightly, but shows an overall stable with minor variations trend, starting at 29.79% and ending at 30.27%. Gross margin is what's left after paying to create your product. If you sell something for $100 and it costs $70 to make, your gross margin is 30%. Higher is better, showing efficient production and strong pricing power. Operational efficiency shows notable improvement. Operating margin is at 21.32%. The trend from Q3 2023 to Q3 2024 shows a consistent upward trend, increasing from 20.5% to 21.32%. Think of operating margin as your business's efficiency score. It shows how much profit you keep after paying for day-to-day operations. If you have $100 in sales and spend $70 on everything from production to salaries to rent, your operating margin is 30%. Profitability shows positive momentum. Net margin is 16.28%. Over the past 5 quarters, we've seen a fluctuating but overall stable trend, with a sharp change between quarters. It started at 15.72% and ended at 16.28%. Net margin is your true profit percentage, the final score of what percentage of sales becomes actual profit. A 15% net margin means you keep $15 from every $100 in sales after absolutely everything is paid for. The company maintains healthy liquidity levels. Current ratio stands at 2.1. Looking at the quarterly trend from Q3 2023 to Q3 2024, we've seen fluctuations, starting at 1.9, peaking at 2.3 in Q4 2023, then dipping to 1.9 in Q1 2024, climbing back to 2.2 in Q2 2024, before settling at 2.1. The current ratio tells us how easily a company can pay its short-term bills. Think of it as having $2 in your checking account for every dollar you need to pay this month. Generally, a ratio above 2 is considered strong, showing the company has ample resources to meet its short-term obligations. The company maintains a conservative debt profile. Debt-to-equity ratio is 0.5. From Q3 2023 to Q3 2024, this ratio has varied. We began at 0.5, decreased to 0.4 in Q4 2023, rose to 0.6 in Q1 2024, decreased to 0.5 in Q2 2024, and ended at 0.5. This ratio is like comparing your mortgage to your home equity. A lower ratio means less financial risk. Generally, a ratio below 0.5 is considered comfortable, though this varies by industry. The company delivers solid returns to shareholders. Return on equity stands at 31.4%. This measures how efficiently the company uses shareholder money. Think of it as the return on investment for company owners. Generally, a return above 15% is considered attractive to investors. The company maintains a robust cash position. Cash to total assets ratio is 16.35%. From Q3 2023 to Q3 2024, we've seen a consistent climb. We started at 10.51%, rose to 10.73% in Q4 2023, 11.41% in Q1 2024, 15.37% in Q2 2024, and now sits at 16.35%. This ratio tells us how much of the company's resources are in readily available cash, like having emergency savings in your bank account. Generally, a ratio above 15% indicates strong liquidity. Now, let us analyze how this company is performing when compared to its peer. The company's price-to-earnings ratio is 27, while their competitors are averaging around 30. In simple terms, you're paying 27 rupees for every 1 rupee of company's earnings, compared to 30 rupees you'd need to pay for the same earnings at their competitors. This lower valuation suggests you might be getting better value for your investment compared to its peers in the market right now, though it's worth investigating why the market has assigned this lower valuation. The company's price-to-sales ratio is 4.73, while their competitors are averaging around 4.24. What does this mean? You're paying 4.73 rupees for every 1 rupee of company's sales revenue, compared to 4.24 rupees for competitors. This higher valuation suggests the market expects superior sales efficiency or growth potential, though you're paying a premium for each rupee of current sales. The company's enterprise value to EBITDA ratio is 16, compared to the industry average of 17. In simpler terms, this lower ratio suggests the company might be undervalued relative to its peers when we look at its overall business value compared to its operating performance. It could represent an attractive opportunity, though investors should understand why the market values it lower than its competitors. Now, let's break down what analysts are expecting over the next 2 years. According to analysts, the company is expected to show earnings per share of 63 rupees in 2025, growing to 71 rupees in 2026, representing a 12% growth. For context, in Indian markets, a growth company typically shows earnings growth above 15 to 20% annually, while mature companies usually grow between 8 to 12% per year. Looking at revenue estimates, analysts project 12% growth. Generally, growth companies in India should show revenue growth of at least 15 to 20% annually, while mature companies typically grow revenue at 7 to 12% per year. Infosys' key strategic initiatives involve several core areas. The company is expanding its generative AI capabilities through the development of small language models for specific sectors, including banking, IT operations, and cybersecurity. It also plans to create over 100 AI agents for client operations. Moving to the next point, Infosys is focusing on securing large and mega deals, with a strong deal pipeline in both categories, signaling a focus on major client engagements. Additionally, Infosys is emphasizing value-based selling, focusing on providing value-added services. Furthermore, the company continues a margin expansion program to improve efficiency and profitability. Finally, Infosys is positioning itself as a partner of choice for clients seeking business transformation through AI, cost management, and improved operational efficiency. Infosys' capital allocation priorities reflect key investment areas. The company intends to recruit over 20,000 freshers in fiscal year 26, following over 15,000 in fiscal year 25, indicating a continued investment in talent. Another key area is the investment in AI models, with Infosys building 4 small language models for banking, IT operations, cyber, and enterprise applications, using proprietary data. The company is also investing in an agile hiring model, aimed at reducing on-site hiring costs. Additionally, Infosys continues to focus on balance sheet optimization to improve the company's overall financial health. Finally, there are GCC investments, specifically a build-operate-transfer deal with a client to establish a global capability center in India for further expansion. The company's execution track record demonstrates several key achievements. Third quarter revenue grew 1.7% quarter-over-quarter and 6.1% year-over-year in constant currency, outperforming market expectations of 1%. Moving to the next point, net new total contract value of large deals increased by 57%, with a 50% sequential increase. The stated metrics show that company margin expanded by 20 basis points during the quarter, supported by strong margin expansion programs, and realization went up by 3.6%. Additionally, free cash flow was at an all-time high of $1.26 billion, reflecting strong operational efficiency and financial management. The attrition rate remained low at 13.7%, indicating effective talent management. Finally, the addition of 5,591 net new employees suggests strong business growth momentum. Infosys' forward guidance provides insights into future expectations. The company raised fiscal year 25 revenue growth guidance to 4.5% to 5% in constant currency, indicating confidence based on strong third quarter performance. However, operating margin guidance remains unchanged at 20% to 22%, suggesting confidence in managing profitability despite wage hike headwinds. Clear drivers of growth and discretionary activities in financial services and retail are provided, potentially improving investor confidence. The emphasis on a stronger large deal pipeline is designed to provide tangible evidence to support the increased revenue guidance. Finally, it's important to note there is no formal guidance on 2026. So, what do you think about this company's future prospects? Would you consider investing in this company? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please take a moment to like this and subscribe to the channel. It's completely free, and your support motivates me to create more in-depth analyses every day. Thanks for watching, and I'll see you in the next video where we'll dive deep into another exciting company.